Everyone is preparing for the next financial crash. Fund managers are holding more cash than at any point since 2008. Retail investors are learning about put options and inverse ETFs. Financial media runs daily segments on recession indicators. The entire market is braced for impact. Michael Burry believes this is exactly the problem. According to Burry's analysis, when everyone is prepared for the same outcome, the actual event unfolds in a completely different way. Today, we examine why Burry thinks the next crash could surprise everyone who believes they are ready. Michael Burry is not a television personality. He is not a Wall Street insider. He is a former medical doctor who taught himself investing by reading every financial document he could find. In 2005, Burry identified a systemic flaw in the American mortgage market that virtually every bank, regulator, and economist had missed. He bet against it. Everyone told him he was wrong. His own investors threatened to pull their capital. The pressure was immense. In 2008, he was proven right, generating returns of over 489% for his investors while the market collapsed around them. This is the man whose current analysis we are about to examine. And Burry is saying something that contradicts almost every mainstream preparation for the next downturn. The consensus view of the next crash is simple. It will look like 2008, a credit event, a liquidity freeze, banks failing, the Federal Reserve stepping in with emergency measures. Investors have internalized this pattern. They watch credit spreads. They monitor bank balance sheets. They expect the same sequence. Burry has argued repeatedly that this mental model is dangerous. In a Bloomberg interview, Burry stated that the last crisis is never the template for the next one. Markets evolve, regulations change, the points of maximum fragility shift. What worked as a hedge in 2008 may be completely irrelevant in the next collapse. According to Burry, the crowd is preparing for a war that already happened while ignoring the war that is coming. Burry's thesis centers on a concept he has written about extensively: the illusion of preparedness. After every major crash, the financial system implements safeguards designed to prevent that specific crash from happening again. After the Great Depression, regulators created deposit insurance and separated commercial from investment banking. After 2008, they imposed stress tests and capital requirements on large banks. These measures work. They successfully prevent the previous crisis. But Burry has pointed out a critical flaw in this approach. The system becomes heavily defended against the last threat while remaining completely exposed to new threats that nobody is modeling. This is not incompetence. This is the nature of complex adaptive systems. They defend against known risks and remain blind to emergent risks. So what does Burry see that the consensus is missing? The first element of Burry's analysis is the structural change in market composition. In 2008, active managers still controlled the majority of capital. When prices fell, some managers saw value and bought. This created natural resistance to total collapse. Today, passive investing dominates. According to data Burry has cited, index funds and ETFs now control more than half of all equity capital in the United States. Burry has argued that this creates a fundamentally different crash dynamic. In a passive-dominated market, selling begets selling mechanically. There is no value investor stepping in to evaluate if the price is now attractive. There is only the algorithm executing redemptions. Burry believes this creates the potential for a crash that is faster and deeper than anything seen in the active manager era. The market structure has changed. The crash pattern will change with it. The second element Burry has identified is the liquidity mismatch in passive vehicles. This is technical, but critical. Index funds promise daily liquidity. You can sell your shares at the end of any trading day at net asset value. But the underlying stocks, particularly in small and mid-cap indices, do not trade with the same volume. Burry has used a memorable metaphor for this problem. He compared it to a crowded theater where everyone believes they can exit through the same door simultaneously. In calm markets, this works. There are always enough buyers. But Burry's research into the 2008 mortgage crisis revealed that liquidity is not constant. It disappears exactly when it is needed most. Mortgage-backed securities traded normally until the moment they did not. Then, there were no bids at any price. Burry believes passive funds carry the same structural flaw. The theater is not large enough for everyone to leave at once. When the rush for the exit begins, the underlying stocks will gap down violently because there is insufficient natural liquidity to absorb the selling. This is not a prediction. According to Burry, this is arithmetic. The third element is interest rate positioning. The entire financial world expects the Federal Reserve to cut rates aggressively during the next recession. This expectation is priced into every asset: long-duration bonds, growth stocks, real estate, private equity. The assumption is that the Fed will do what it did in 2008, cut rates to zero, implement quantitative easing, flood the system with liquidity. Burry has raised a question that very few analysts are seriously considering. What if the Fed cannot cut rates this time? What if inflation remains structurally higher than it was in the 2000s? What if cutting rates aggressively would risk unanchoring inflation expectations or crashing the dollar? Burry has not predicted this scenario with certainty, but he has pointed out that the market has not priced any probability of it occurring. If the Fed is constrained in its response, either by inflation or by political pressure or by concerns about currency stability, then every asset priced for aggressive easing will reprice violently. This would be a crash that catches the consensus completely off guard because the consensus assumes the Fed put is unlimited and permanent. The fourth element Burry has discussed is the global dollar shortage. This is a concept most retail investors never encounter. The global financial system runs on dollars. Foreign banks need dollars to settle international transactions. Corporations outside the United States borrow in dollars because rates are lower. Emerging market governments issue dollar-denominated debt. When a crisis hits, everyone needs dollars simultaneously. In 2008, the Federal Reserve opened swap lines with foreign central banks to provide dollar liquidity and prevent a global seizure. Burry has noted that the scale of dollar-denominated debt outside the United States has grown massively since 2008. According to Bank for International Settlements data that Burry has referenced, there are trillions of dollars in offshore dollar liabilities with no corresponding dollar assets. If a shock occurs and foreign entities scramble for dollars, the Fed would need to provide liquidity on a scale that dwarfs 2008. Burry has questioned whether this is politically feasible in the current environment. If the Fed hesitates, or if Congress resists international bailouts, the result would be a cascade of foreign defaults and a global depression that makes 2008 look contained. This is a tail risk. But Burry's entire career has been built on recognizing that tail risks have fat tails. The fifth and most counterintuitive element of Burry's analysis is the danger of consensus hedging. When everyone holds the same hedge, it becomes the risk. After 2008, put options on the S&P 500 became the standard crash hedge. Buying puts became synonymous with being prepared. Burry has pointed out the mechanical problem with this strategy. If everyone owns puts and a crash begins, everyone tries to exercise or sell their puts simultaneously. This forces market makers to hedge by selling the underlying stocks, which accelerates the crash, which increases demand for puts, which forces more selling. The hedge becomes a feedback loop that amplifies the collapse. Burry has written that the best hedge is the one nobody else is holding. If you are hedged the same way as the consensus, you are not hedged. You are simply exposed to a different kind of crowding risk. What this implies is deeply uncomfortable. It suggests that the retail investor who learned about put options after 2008 and feels prepared may actually be positioned in a way that makes their portfolio more fragile, not less. So if Burry's analysis is correct, what does it mean for the next crash? It means the crash will not announce itself the way 2008 did. There will be no obvious subprime moment, no Lehman Brothers failure. The trigger will be something the consensus is not watching. It could be a liquidity event in a passive fund that forces fire sales. It could be a sovereign debt crisis in a country the market assumes is stable. It could be a political decision that removes the assumption of Fed intervention. The crash will begin in a place the models do not cover. And because everyone is watching the wrong indicators, the recognition will be late. By the time the consensus understands what is happening, the exit will already be crowded. Burry has described this pattern as the fundamental structure of every surprise collapse. The crowd prepares for the known risk. The collapse arrives from the unknown risk. The preparation proves useless. Burry himself rarely gives investment advice to the general public. His letters are written for sophisticated institutional investors, but his methodology offers a framework that any investor can apply. The first principle Burry embodies is to read the primary source, not the headline, not the analyst summary, the actual document. If you own an index fund, have you read the prospectus? Do you understand exactly what happens to your shares during a liquidity crisis? If you own a bond fund, have you read the fund's rules about suspending redemptions? Burry's edge in 2008 came from reading mortgage prospectuses that nobody else was reading. The information was public. The effort was rare. The second principle Burry demonstrates is to model the scenario the consensus ignores. Everyone is modeling a 2008 repeat. What happens if the Fed cannot cut rates? What happens if inflation stays high during a recession? What happens if foreign central banks stop buying treasury bonds? These are not the base case. But Burry's philosophy is that the base case is already priced. The alpha is in the scenario everyone assumes is impossible. The third principle is to respect illiquidity. Burry's fund had a lockup period. His investors could not redeem during the crisis. This allowed him to hold positions through the panic. Most retail investors do not have lockups. They have the opposite. They have instant access to selling, which means instant access to panic. Burry has said that the ability to sell at any moment is often a disadvantage disguised as a feature. If you cannot tolerate illiquidity, you cannot tolerate the positions that generate the highest long-term returns. The fourth principle is to act on your own research, not on consensus comfort. Burry was wrong in the eyes of every major institution on Wall Street for 2 years before he was right. The pressure to conform was immense. His investors were furious. His peers mocked him. But Burry had done the work. He had read the documents. He trusted his analysis over the consensus. This is not arrogance. This is the discipline of independent thought. What Burry's framework reveals is that being prepared for the next crash is not about buying the right hedge. It is about thinking differently than the crowd. If you are holding the same hedge as everyone else, you are part of the crowd. If you are watching the same indicators as everyone else, you will be surprised by the same event as everyone else. Burry's edge has never been superior prediction. It has been superior preparation. He prepares for scenarios others dismiss. He reads documents others skip. He models exits others assume will never be needed. This approach does not guarantee profit, but it does guarantee that when the consensus is catastrophically wrong, you are not standing in the same crowded theater trying to exit through the same door. Today we examined Michael Burry's framework for understanding why the next financial crash may surprise even those who believe they are prepared. We explored his analysis of passive investing concentration, liquidity mismatches, interest rate assumptions, global dollar shortages, and the danger of consensus hedging. Burry's record suggests that the consensus is usually right until it is suddenly and violently wrong. The transition happens faster than models predict because models are built on the assumption that the past is a reliable guide to the future. Burry's philosophy rejects that assumption. Every crisis is different. Every collapse catches the prepared off guard because they are prepared for the last collapse, not the next one. The question Burry's work leaves each investor with is simple. Are you prepared for a crash that looks like 2008? Or are you prepared for a crash that looks like nothing you have seen before? The answer to that question may determine whether your preparation protects you or simply gives you false confidence while the system breaks in a new way. Thank you for watching.